This is a video on 5 things I look for whenever I'm looking into a stock, whenever I'm trying to analyze or think about a company. It's really good for beginner investors that are trying to learn how to value stocks in the stock market. These are 5 basic things I look for, and they are very, very important. I'm going to share all of them. The last one is going to be the most important one, which is why I value stocks over the next 5 years, not over the next 10 years. And this is really going to be something very helpful. So I really hope you enjoy these kind of videos. If you do, please press the like button and maybe leave a nice comment or a mean comment or whatever you think of the video. If you disagree with me, let me know in the comment. This is the first one, and this is the biggest one that I see on YouTube, especially on Twitter, under my own comments. And this is mainly that a great company doesn't equal a great investment. So many people, they start looking into a stock, oh, it has high return on invested capital, it grew that much over the last 10 years, it did all that stuff. This is a high quality company, this is an amazing company. So it means this is a great investment. Or if they see a company, let's say like Pfizer, it did not grow in revenues over the last 10 or 15 years, and the stock price hasn't moved, and some company has low return on capital, or even declining earnings. They automatically believe that this is not a great company, which means it's not a great investment. This is the biggest misconception that a lot of people have. And a great company doesn't equal a great investment. A great company can be a terrible investment if you pay too much for it. And conversely, a bad company, a terrible company, a garbage company can be an amazing investment if you pay the right price. And the best example I can think of is a company called MSCI. This is a stock a lot of people perceive as a high quality company because they have high return on capital, increase in earnings, and revenues have been growing. Also, they have subscription-based revenue. Another one was MasterCard before it broke out. But I can talk about MSCI. MSCI has been, if you look at it from 2021, MSCI has been basically flat for 3 years, even though it's a high quality company. But if you bought it in 2021, just because it was a great company and you did not pay attention to the price, you have overpaid. And the company is taking time to grow into the overvaluation. And this is why the company has been flat for 3 years. Even though the company has improved, the stock has been flat for 3 years. It's a high quality company, but it does not mean it's a great investment. There's a very big difference. Even, Howard Marks said it. It's not what you buy, it's what you pay for it that determines whether something is a good investment or not. You could buy the best company in the world. If you pay too much for it, you're going to suffer 3 to 5 years of flat returns. And if you compare it to the S&P 500, you're losing money on an opportunity cost. So a great company doesn't equal a great investment, and a bad company does not equal a bad investment. This is something really important to keep in mind if you're looking into valuing a stock. The second thing that I do, and I encourage most people not to do, is to not use a valuation website or a DCF on every single stock. And this is, again, something built on YouTube, because you have a lot of people on YouTube that have their own websites where you put in the ticker and it gives you the intrinsic value, or it gives you the fair value, or it gives you an automated DCF. I'm sure you've seen many of that stuff. And to me, this is the biggest lie I've ever seen. Because the truth is, you cannot value every stock the same way. You cannot value ExxonMobil the same way you value Nvidia, the same way you value a dividend stock, the same way you value a gold miner, the same way you value a lithium miner. It's impossible. You cannot value every stock the same way in the stock market. But I've seen so many videos and so many things on Twitter where they use a DCF for every single stock, or they use some kind of website where you put in the ticker and it gives you a fair value or an intrinsic value or whatever it is. And it's impossible. For an oil stock, you have to take into consideration the price of oil. How can you incorporate all that stuff in a valuation website where you just gives you the ticker? That's impossible. Same thing with other stocks. Or if a company has declining in earnings, like when I was buying GEO, which was one of my biggest gainers. GEO, even Sandstorm, which I talked about, was declining in free cash flow. And people looked at it on DCF. They put in the comment, this stock is trash, it's not a buy. It's declining in free cash flow. Well, it's trading 3 times below tangible book value per share. You have to look at the assets, look at the balance sheet. You have to look at many different things. So putting a ticker in a DCF or a website and it tells you the fair value is the biggest scam ever. Each stock is valued differently, and I do different valuations model on my own channel. As you could see, some stocks I value them with some kind of basic valuation model. Other stocks I value them on assets, tangible book value per share. sometimes on earnings growth, sometimes on free cash flow. Dividend companies, I look at the dividend and the shareholders yield. So every single company is different. And I try not to use a valuation website or a DCF on every stock. The third thing I pay attention to whenever I'm valuing a company, and this is something that I go by, and this is that debt doesn't matter as long as it's payable. I don't skip stocks just because a stock has a lot of debt. This is another big mistake that people make. But some people, they just don't like a lot of debt. That's fine. Like if you're more conservative, you like a clean balance sheet, that's good. But from my own thesis, the way I see it is everyone likes a clean balance sheet. And because everyone likes a clean balance sheet, or most people prefer a clean balance sheet with no debt and amazing cash, these companies normally get bid up in valuations. Very rarely you find a company with no debt that or very little debt that's trading at a cheap multiple. Maybe Ulta Beauty is an exception, but most stocks, they trade at a premium, which means I can get a discount if I buy a company with higher debt. So whenever I see a company with high debt, I don't immediately skip it. I see if the debt is payable or not. And you guys see it in my videos. I encourage you to watch some of my analysis. I go on the 10Q. Normally it's a 10Q, sometimes on the 10K. You go into debt, they put up the long-term maturities, and you can see what is the debt maturing every single year, what is the amount, and you could take the free cash flow, and you could see, how much dividend obligations they have. Just multiply the dividend by shares outstanding. You get the annual dividend commitment. Then you look at whatever they have in free cash flow and whatever they can pay in debt. And for me, if the debt is sustainable, I would much rather buy a company with debt than no debt. I know it sounds crazy, but I don't like companies with clean balance sheet because there's not as much upside as companies that people don't want that have some kind of debt that could be paid off. When the debt is paid off, it first experiences a multiple expansion because it's becoming more efficient, just safer company. The second thing is it saves on interest expense, which is will automatically increase free cash flow as the interest expense comes down. It's increase earnings per share and net income also. So there's just much more upside for me with companies that have some debt. But again, I don't skip a company just because it has some debt, or just don't also look at long-term debt in general, or I mean total debt. Don't look at total debt just to base your thesis, because some of it is just lease obligations. It's not really debt, and then it wasn't included in the balance sheet before 2018 or 2019. So I only look at short-term debt and long-term debt. I don't look at lease obligations much in terms of debt, but it's important to not skip a stock just because it has high debt, and try to see if the debt is payable or not. Something else that I look at, which is not a lot of people talk about, is very important. And this is to look at the gap between the GAAP and non-GAAP EPS. So a lot of people on Twitter, they told me, hey, look at Cisco. Cisco is undervalued. It's trading at 13 times earnings. Now, Cisco is a good company, not bad at all. They have very high margins, high return on capital. 13 times earnings looks dirt cheap. Yet the stock has just kept going down. And the reason it kept going down is because the stock is overvalued. It's not really trading at 13 times earnings. It's trading around 18 times earnings because there's a huge gap between the GAAP and non-GAAP EPS. For 2023, GAAP was 307. Non-GAAP is 389. This is a huge gap between the two. For 2024, 253 for EPS GAAP. Non-GAAP is 371. This is massive. Other companies are notorious for that stuff. Adobe is notorious with that stuff. PayPal has fixed their problem, but Adobe is another one. Adobe is not as cheap as it looks. If you look at it on GAAP versus non-GAAP, it's very important to determine why there's such a big difference. It's normally just stock-based compensation. Sometimes it could be one-time expenses, and in this case, you could use non-GAAP. But it's better to use GAAP in general and try to see if there's a very big gap between the GAAP and non-GAAP EPS for you to determine why there's such gap, and to not be fooled whenever you look at forward earnings trading at 13 times. Not really. It's trading around 17 to 18 times, which makes Cisco not as cheap as you saw it in the beginning. And this could make all the difference in the world whenever you're valuing or trying to buy a stock. Now, this is the last point, and this is the most important one that I want to comment on, because I'm sure a lot of you are curious. Why don't I value stock for the next 10 years? Why do I only look for doubles every 5 years? Why is that? It's random. Most people do 10 years, 15 years. They buy, let's say Apple. Let's say in 10 years, Apple is worth, I don't know, $300 per share. So this is what most people base their thesis on. But I have something different, and I'm going to tell you why. Let's assume a stock, let's say Apple, is trading at $100 per share. Okay? and we do a DCF on it or whatever you want to do, and we determine that in 10 years, Apple is going to be a $300 stock, meaning Apple is going to 3x in 10 years. This is an amazing return. So if you have $300 in your mind and the stock is trading at $100, a lot of people claim, and maybe you will claim, that it doesn't matter what price you pay. You could pay $150 for Apple, you could still get a double. You could pay $120, you could pay $110, you could pay $95, you could pay $160. It doesn't matter because Apple is going to $300 per share 10 years from now. Now, what if in year 7 or year 8 something happens and your competitor you didn't expect comes along, something crazy happened, and all of a sudden that $300 per share is gone, and maybe the upside is to $200, and you paid $150 or $160, you end up with like a 30% return in 10 years. It's really, really bad. And for me to try to avoid it, I only look for stuff over the next 5 years. Because if I buy Apple at $100, and I say Apple is worth $200 in 5 years, I know I can only pay $100 to get my double or get the 15%, which is normally double the 7-8% S&P. So if Apple is worth 200, I could only pay 100. I cannot pay 105, I can't pay 110, I could pay 100, I could pay 95, get some margin of safety, $90, but I can't pay more than $100. So this will help me in not overpay for the stock that I'm actually buying. And something else that I believe in is that I know it's hard to view, the economy and view what's going to happen with the S&P or with certain stocks for 10 years. But it's much easier to do it over the next 5 years. Even 5 years is a long time, but 10 years is a much longer time. So I think if something bad is going to happen, it could happen anytime, of course, but I think 10 years is way riskier. It's very hard to see what's going to happen. 10 years from now, it's a little bit easier to see what could potentially happen 5 years from now in terms of interest rates. Even the Fed forecasts their own interest rate stuff, and you could use some of those things to set up a good valuation model or set up a fair multiple on the stock. So I only do it over the next 5 years because I don't want to overpay. And it's easier to see what could potentially happen over the next 5 years than put it in 10 years, have a 10x number in your mind or whatever it is, and overpay by making a big mistake. Sometimes I do value stocks for 10 years, my speculative microcap stocks, but most of my stocks, if I can't get it double at least over the next 5 years, I'm not buying the stock. And this is how I do it. And these are my 5 basic things I believe in or I look for whenever I'm valuing or want to invest in a stock. I share more of that stuff in my own Patreon, my own Discord. If you're interested, this is the link over here, or you could find it in the description. But thank you again for watching. No financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.